Good evening, ladies and gentlemen. Today we will be discussing fundamental concepts of wealth building, tax strategies, and investments. These principles are applicable worldwide, regardless of the specific financial system or country you're in. Our goal is to give you a deeper understanding of how money works and how you can use it to your advantage. The financial system. Let's start by understanding how the financial system works. Most people earn a salary and deposit it into a bank account. This may seem simple, but it's the beginning of a complex system of money flows. Banks use this deposited money to lend it to others, creating a cycle of debt and credit. This system also includes insurance products, pensions, and other financial instruments. It's important to understand that once your money is in the bank, it doesn't just sit there, it's actively used by the bank. But what really happens to your money after you deposit it in the bank? The answer might surprise you. How banks make money. Banks typically pay very low interest rates on deposits, often less than 1%. They then lend this money at higher interest rates, say 4%, and make a profit from the difference. This explains why you see banks with their names on large buildings. It's a profitable business model. Let's consider an example. If you deposit 10,000 euros into your savings account, you might receive perhaps 100 euros in interest at the end of the year. The bank, on the other hand, could lend this money for 400 euros, giving it a profit of 300 euros. Multiply that by millions of customers, and you can see why banks can be so profitable. The fractional reserve system. Banks operate on a fractional reserve system. For every euro deposited, they can lend out a multiple of it. This creates a multiplier effect in the economy, but also increases risk. Let's assume the reserve requirement is 10%. If you deposit 100 euros, the bank can theoretically lend out an additional 900 euros. This leads to money creation in the system. While this can stimulate economic growth, it also carries risks, especially if too many loans default. But what would happen if all customers wanted to withdraw their money at the same time? The answer to this question reveals one of the biggest vulnerabilities in our financial system. Other people's money, often abbreviated as OPM, is a powerful tool used by successful investors and business people to grow their wealth. They borrow money from banks, insurance companies, pension funds, and various other sources to invest in assets that yield higher returns than the cost of borrowing. This is, honestly, a key concept in finance. Instead of working only with your own money, you use other people's money to leverage your investments. The trick, of course, is to find investments that yield more return than the interest you pay on the borrowed money. Real estate investment strategy. An effective strategy is investing in real estate, particularly multifamily housing. Here are some reasons why. There's a constant need for housing. People always need a place to live, regardless of the economic situation. Real estate offers tax advantages through depreciation. You can deduct the depreciation of your property from your taxes, even if the actual value increases. You can use leverage or debt to increase returns. With a 20% down payment, you can control a property worth 5 times as much. Real estate often appreciates in value. Over long periods, real estate tends to gain value, accelerating your equity buildup. Rental income provides a steady cash flow. Unlike other investments that only rely on appreciation, real estate generates regular income. But there's a real estate investment strategy that can be even more profitable than simple buy and rent. In a few minutes, I'll tell you how you can double your returns with this method. Value-add real estate investment. A common strategy is buying underperforming properties, improving them, increasing rents, and refinancing. This allows you to pay back the originally invested capital to yourself or your investors while still owning the appreciating asset. Here's an example. You buy an apartment building for 1 million euros. You invest 200,000 euros in renovations and thereby increase rents by 20%. The value of the building rises to 1.5 million euros. You refinance based on the new value, pay back your original investment, and still keep the property with its increased cash flow. Tax advantages of real estate. Real estate offers significant tax advantages. Depreciation can offset rental income and often lead to paper losses while still generating positive cash flow. Interest on loans is tax deductible. This significantly reduces your taxable income. Capital gains can be deferred through 1031 exchanges. You can reinvest the proceeds from selling one property into another without immediately paying taxes. Cash-out refinances are not taxable events. You can pull equity out of your property without it being considered income. Taken together, these benefits can lead to real estate investors legally paying very little to no taxes while building their wealth. But there's a tax advantage that most real estate investors overlook. This one trick could halve your tax burden. Stay tuned to learn more about it. The 4 cash flow quadrants. Robert Kiyosaki's cash flow quadrant illustrates how different income sources are taxed. Employee highest tax rate, often around 40%. Employees have the least control over their taxes. Self-employed can be up to 60% due to self-employment taxes. Self-employed individuals have a bit more control, but also bear more risk. Business owner, often around 20% due to more deduction possibilities. Business owners can deduct many expenses as business costs. Investor can potentially pay 0% through strategic investing. Investors have the most opportunities to optimize their tax burden. Understanding which quadrant you're in and how to move into the more advantageous quadrants is key to building wealth. Government incentives. The tax code is designed to encourage certain behaviors. Job creation companies that create many jobs often receive tax benefits. Housing development. Due to the constant need for housing, there are many incentives for real estate developers. Energy production, especially renewable energies, are often tax-favored. Agriculture food security is important for governments, so there are often benefits for farmers. Technological advancement innovations are often promoted through tax credits and other incentives. By aligning your investments with these incentives, you can significantly reduce your tax burden. It's about understanding what the government wants to promote and aligning your business activities accordingly. But there's one sector where government incentives are particularly lucrative. Investors in this area can reduce their tax burden to nearly zero. Which sector is it? You'll find out shortly. The ultimate goal is to generate cash flow. The purpose of income is to generate cash flow. Income alone is not the goal, but what you do with it. The purpose of an expense is to generate income. Every expense should be viewed as an investment that creates added value. The purpose of an asset is to generate income or reduce expenses. A true asset puts money in your pocket. Debt should only be used to acquire assets that produce income. This distinguishes good debt from bad debt. Understanding these relationships allows you to optimize your financial decisions. Instead of simply striving for a higher salary, focus on building assets that generate passive income. Many people fear debt, but what they really fear is not being able to repay it. The key is to invest in assets that you understand and trust to produce reliable income. Let's take a rental property as an example. If you've thoroughly researched the location, condition of the building, and local rental market, you can predict the expected rental income with reasonable certainty. With this knowledge, you can confidently take out a loan, knowing that the rental income will cover the mortgage payments. When you trust your assets, you can confidently use leverage to accelerate wealth building. Instead of saving for years to buy a property in cash, you can start building wealth immediately with a down payment and a loan. However, there's a method by which you can drastically reduce the risk of your investments while simultaneously maximizing your returns. This strategy is used by the most successful investors in the world. What's their secret? I'll tell you in a moment. Success in wealth building requires continuous education and personal development. The financial world is constantly evolving. What worked yesterday may not be optimal today. Stay up to date on market trends, legal changes, and new investment opportunities. Building an expert team, like accountants and lawyers, is crucial. You can't do everything yourself. A strong team of professionals can help you make informed decisions and avoid costly mistakes. Creating systems to manage and grow your investments is also important. As your portfolio grows, systems and processes become more important. These help you keep track and work efficiently. Understanding that every investment is ultimately valued based on its cash flow is key. Whether stocks, bonds, or real estate, in the end, it's about how much money the investment generates. Financial education is the key to success. Unfortunately, this important topic is not adequately addressed in most schools. It's up to each individual to educate themselves and understand how money works. Start by reading books on personal finance and investments. Attend seminars and workshops. Surround yourself with people who are already successful in what you want to achieve. Learn from their experiences and mistakes. Remember that financial education is a lifelong process. The financial world is constantly changing, and what works today could be obsolete tomorrow. Stay curious and willing to learn.